You're watching Personal Finance with Coach Kelvin. Let's get into the video. Hey guys, Coach Kelvin here, and today I want to talk to you about all of the acronyms that are in investing and try and make some of them seem a bit more simple and explain some of the terms that also get used, okay? Because there are a lot of like new phrases, new acronyms, and it feels like a whole new language when you first start with investing. So we're going to try and simplify some of these things. So the first acronym I'm going to show you or go through is ETF. Now ETF means exchange traded fund, and a good analogy for this is imagine an exchange traded fund is like an egg carton, okay? And every egg that is inside that carton is a different company. Now these companies may be part of one sector, or it may be the entire index. It really depends on what the whole the ETF tracking objective is. So an exchange traded fund in the traditional sense is usually tracking an index. For example, I hold VAS, the Australian top 300 company exchange traded fund. So this is like a 300 egg carton, and it has that many companies within it, okay? Now, there are certain ETFs which may track based on market capitalization. So obviously the top performer in that index, the highest market cap, will have a larger percentage holding than the bottom. So then there are also equal weighted ones where it may be one egg represents the same amount. So think of an ETF like an egg carton, okay? You next have LEIC. Now this is a listed investment company. These are generally actively managed. They are rebalanced, not based on the index, but based on what the managers want to do. They generally have low fees, especially some of the old ones here in Australia. They keep a lot of cash on balance, so they need to pay out their shareholders dividends, but they don't need to pay out 100% of the cash that they earn like an ETF does. So that means their dividend can be held stable during market dips and volatility. For example, last year with the pandemic, listed investment companies here in Australia were still able to pay out really good dividend yields because they were just paying out from the cash reserves. So LIC is a listed investment company. The next thing I'm going to talk to you about, or the next acronym, is MER. So your MER is your management expense ratio. Now your MER basically is referring to the amount you have to pay for having money invested through that particular fund or that ETF. So for example, when I was talking about VAS, the ASX 300 ETF, this has an MER of 0.1%, which means for every $10,000 you have invested, you pay a fee of $10, okay? So you really have a very low expense to partake in this tracking of the fund. So the lower your MER is, generally the better your returns are going to be because you're losing less money eaten up in fees over time. So MER, management expense ratio. The next is the NTA, which is net tangible assets, and this is referring to all of the assets, the total value that the fund holds. Okay, so you might have 300 different assets within a fund or within a company, and it will give you what the price of everything is accumulated. If we look at a similar sort of acronym, this is FUM, funds under management. This will be more applicable to an actively managed fund, a hedge fund, an ETF. And FUM, or funds under management, is the entire amount of money that has been invested throughout this company or through its holdings. So if our VAS had 10,000 shares on issue and each of them were worth $1, then its funds under management would be $10,000. Believe me, I wish these ETFs were only worth $1. They're a lot more, but that was just a super simple example of how funds under management is sort of referred to. Now, the next kind of few phrases are not really acronyms, but we have two ways to describe a market, okay? There is a bear market, which is basically when everything is falling back, there's a lot of fear, uncertainty, and doubt, and that's another acronym I'll get to. And people are selling off, so the price of shares is dropping. This is called a bear market, and this usually occurs after a 20% drop in the shares. It's referred to that. Now, if we have a long period where there's a lot of investor fear and people are really uncertain and scared, then the price of the entire index or the market tends to not move too much. It tends to stay low or fall. You get obviously your smart investors buying during these times, but your retail investors are really scared and they tend to stay out of the market. So a bear market, I like to think of this not as a bear as in the animal, but think about it as like barely any activity. So when there is a bear market, there is less people buying in, there's less funds going into investments and more coming out. With a bull market, which is the opposite, a bull market is, imagine a charging bull just going forward and going hard. It's going to knock anything else out of its way. So a bull is onwards and upwards in the growth cycle of the market. So a bull market is referring to an upward trend in the stocks. It is referring to continuous growth, and generally speaking, most of the time, because the market does trend upwards, the bull markets last longer than the bear markets. Don't quote me on this, because obviously past performance is no indicator of future performance, but since the inception of time that shares trading occurred, the upward trend through human endeavour into money inflowing into the share market exists. Therefore, a bull market is upwards, a bear market is downwards. Okay? Now, the next thing I was going to talk about is FUD, or FUD, it's often called. Now, this is fear, uncertainty, and doubt. When investors have fear, uncertainty, and doubt, and they're trying to think about investing into the stock market, what generally happens is they let media hype steer where they're going, where they're putting their money. They freak out, they get really scared and uncertain and nervous. So people might buy in to something without researching it because they think they will miss out if they don't. Or they might sell off something because they don't understand why the price has come down. So for example, yesterday we saw a global blackout with Facebook, and it was down for several hours, causing a lot of money to be lost. Obviously, as a result, we've seen a dip in the share price from Facebook. Now that's completely okay. The share prices move forwards and back, they do move around. But an investor acting out of FUD, or fear, uncertainty, and doubt, is more likely to have sold those shares than buy them during that time. Whereas an investor who's excited by a market dip and is wise and seeing this as just a short-term pain will see that as an opportunity to get a little discount on the shares they wish to buy. So FUD, it's kind of like it's talking about the psychology of investors, how their emotions affect their behavior. Okay. Now, there's obviously a lot of other acronyms out there and other terms used for investing, so we're going to keep moving on with this, okay? So, the next thing is DRP. Now, DRP is referring to your dividend reinvestment plans. So, when you buy shares and the companies that you buy the shares in have earnings, they will pay you a dividend, and if they don't, the share price goes up. But those dividends, some companies actually allow you to reinvest them automatically. And quite often they'll also offer this at a discount. So when a company offers a dividend reinvestment plan and you receive your dividend, instead of having cash come into your bank account or your brokerage account, what you'll receive is new issues of those shares. So this is really cool because you're going to have this passive growth in your portfolio without having to actually ever buy those shares again. The amount of shares you hold will still increase as your dividends are paid to you in the form of those new shares. Dividend reinvestment plans are a bit of a best friend to the passive investor, but if you want to get more active, you can just receive the cash, and then from there, you can choose where you spend that money. If I was holding shares that I wasn't satisfied with what the company was doing, but I didn't want to sell, I might turn DRP off in order to then divert those funds somewhere else where I believe they're going to be used more productively. So DRP is your dividend reinvestment plan, okay? Now this is obviously something I've talked a fair amount about on this channel, but it's because dividends reinvested make up for about 40% of the total market returns. If we're seeing an average return of about 8% over the long term in Australia, and then you're having a lot of dividend yields around the 5-6%, we're getting a lot of our dividends actually contributing to the growth of the portfolio, not just capital appreciation. In the United States, however, the dividend yields tend to be a little lower, but the capital appreciation is higher. So dividend reinvestment plans are a great way to have your your holdings of a company grow, and you don't have to pay brokerage either. So if every trade normally costs you $10, for you to have this, it will not cost you $10 if your DRP is enabled. Alright, I think that is it for today, guys. So those are a few acronyms and terms to help you get your investing language up to scratch. Obviously, it does feel like a completely foreign language when you first start, but stay with it, because the more time you spend researching about your investing, the better you will get. Alright guys, thanks for watching. If you got any value from this video, please like, share and subscribe, and I really look forward to seeing you in the next video.